Hey, what's up, guys? Welcome to the channel. Today we're going to be talking to Joe, and he's kind of the master of credit and teaching about credit scores. He's been helping clients do this regarding buying houses, and this is actually really relatable to buying homes. So today he's going to talk about how to actually build your credit and get it to the point where you're going to be extremely successful when you decide to buy your first real estate investment. So, Joe, before we start, can you tell the crowd a little bit about yourself?
What's up, guys? Joe Ramos here, and I just wanted to talk to you a little bit about credit and why it's important. So having good credit is going to help you along in the future, especially if you want to become financially free. Let's say through real estate or in business, having a good credit score is going to allow you to be able to use your personal guarantee to either build a company or build your investment portfolio.
So, Joe, why should people even care to build credit, to be honest? So why does it matter?
Well, the reason that having a better credit score matters is it's going to allow you to get a better deal on your home and make it a lot easier for you to do that. So the higher the credit score that you have, obviously the better rate you're going to get and the better programs that you'll be able to qualify for.
What's the range of credit scores?
Like 300 to 900. So yeah, 300 is really, really bad. Don't quote me because I'm not a loan officer. I've done a lot of loans myself. Luckily, my credit's really good, so I don't have to worry, but you have to have a specific credit score to even qualify for a home loan, which I think is right around like 620, 630. Maybe that's something we can double check on. But obviously, the higher the credit score you have, the lower the interest rate and the better payment, and the easier it is going to be for you to qualify.
And it honestly kind of depends too, depending on what type of loan you get. Like if you're getting like a first-time home buyer loan, your credit score actually doesn't need to be as high. So if you have like a 650, 60, still talk to your lender and see that getting an FHA loan is a possible option for you. So now that we kind of like talked about the ranges and why it's important to have a really good credit score, can you kind of say like if you have like a 650 versus like a 700 or 740, what changes about like your loan? Are you still able to get the loan? I know we talked about like FHA is okay, it's a little lower.
Yeah.
What other things should they know?
All right, so let's say you're able to get a loan and they're able to qualify you, but your rate is a little bit higher and you only make a certain amount. So now your debt to income, your DTI as they would say, is gonna be worse. So the better your credit score, you're actually gonna help your DTI and be able to possibly get a more expensive house than you originally were hoping for.
A little bit. Can you explain DTI? Like, I don't really.
So debt to income. So if you make $10,000 a month and your payment is $3,000 a month, your DTI around 33%, somewhere around there. So let's say you have, a lower credit score and the bank is saying, well, you can get this house if your credit score is higher because your payment's going to be lower because you're going to have a better interest rate. And so now your DTI will not be thrown off as much.
So basically we're trying to get like a ratio for the lender to have like a low enough payment where it makes sense that you can still actually afford the space.
Yes,
kind of like what it
yes,
is.
because I believe you have to be right around like the max is 38%. And we're talking if you're doing a regular home purchase. Obviously, if you're doing investment property or a DSCR loan, which is a debt coverage loan, which we can go into at a later time, that's different. But we're talking like, let's say it's your personal home and you want to buy a $500,000 house, but your credit score is kind of low, so your interest rate's going to be high and you're not going to qualify because you don't make enough. Well, instead of having to go find a job to make more money, why don't we just improve your credit score so that way we can bring that payment down and now ultimately you can qualify. Because if you're over 40%, then the bank isn't going to allow you to finance the property. And what goes into that as well is if you have, let's say, a car payment or credit card payments or student loans, all those things factor into your debt. So if you're able to get rid of a car payment or get rid of some of those student loans, that'll actually build up your credit as well as help you to remove that off of your credit so you can qualify for a property. And I personally did that on my third house. I actually sold a really cool Audi that I had because my payment was a ridiculous payment, but I wanted to buy another property because that was more important to me. So I ended up taking that off of my credit, and that was another $800 a month that I was able to use to be able to qualify for the property, because that goes a long way when you're qualifying for a property, even though it may not be like a lot when you think about, oh, my car payment's only $400, but $400 on a house can make a big difference in qualifying, right?
Exactly. Yeah. So obviously Joe has the need for speed, guys. You got an Audi. That's the biggest point from the. If they like, say you're like 25 to like 45 years old and you really don't have that many assets, because it sounds like you're in a really good spot. Like financially? Like back then, I'm not sure how. What was your situation back then? Did you have like
Okay.
a lot of assets or?
So when I bought my first house, I was 21 years old, and I had a car payment, and I probably made, I don't know, around 60, maybe $70,000 a year. But the house that I purchased was only 228,000. So I was able to qualify for that house on an FHA loan. So I did 3.5% down, which was about $6,500, and this was in 2008. So yeah, it was a while ago, and a lot of people will say, "Oh my gosh," but it was a long time ago. But there's still ways to do it for people now. Obviously, things that have changed, but I didn't know what I was doing. But I just knew that I wanted to buy a house because I was renting with some friends, and I kept on taking that money to the landlord and paying their payment, and I thought it was ridiculous. So, seeing if those guys would move in with me if I found a house. So they each paid $500 a month, and my payment was $1,300. So I almost lived for free. And that's kind of how I got started, and I got addicted to kind of buying houses at that point, because I just saw the value that it brought, and especially because as I got older, I started making more money, so that helped me with my tax burden as well, because I had a write-off.
So honestly, like as you guys can just tell, the biggest thing is actually taking action. Joe was 21 years old when he first bought his house, which is to me kind of like insane. But if you're like 21 years old, that just shows you that it is completely possible. The biggest thing I would say, again, take action, ask the right people the questions, and just let them know like, hey, I heard about this guy, Joe. He bought a house when he was 21 years old. How do I actually do the same exact thing as him? And then, Joe, I guess this is a good time to ask, but how can they find you in case they want to have, if they're 21 years old or if they're 25 years old and they want to buy their first house, where can they actually connect with you?
Well, I am SoCal Traveler on Instagram. I'm SoCal Traveler on YouTube, and we have a podcast called Land Sharks Financial Freedom, which Jeff was actually a guest on our show not too long ago. So I'm sure we could put that link in the description as well.
So yeah, if you guys are looking for him, make sure you hit him up and like, comment, sub. Really appreciate the support. You'll learn a lot more about financial freedom and basically retiring through real estate. So now that we've kind of talked about that, if I'm 21 years old, I don't really have much to my name, and I want to buy my first house using FHA loan.
Okay. All right. So where I would start is a few places. So I would start with finding a really good loan officer, and also check what your credit score is. So get with that loan officer, have them run your credit, and have them check your credit. I know a lot of people don't like to get those dings on their credit, but this would totally be worth it, especially if you are serious about buying a house within the next 6 months to a year, because they'll be able to tell you where you're at. And that's what you need to know to be able to either fix it or improve it, right? And so they can really tell you, okay, you need to be here to qualify for this house. Well, now you take the steps of checking out what is exactly on your credit. And personally, I would print it out and see exactly what's on your credit. If you don't have anything on your credit, go get a credit card. And if you can't qualify for a credit card, start with like a Capital One. They are called secured credit cards. You could put, let's say $500, it's either $300 or $500. You put your own money up, you use that, and then they can kind of see like how you're using the money, and from there they'll qualify you for a real credit card, as long as you obviously have the right utilization with it.
Yeah. So what should I be buying with my credit card? Should I just go and buy like food, or should I can go buy some Gucci wallets?
Well, I think that's a really good question, actually, because what I always suggest to people is I use my credit cards for everything because I get points on them. And so to me, a debit card is useless. And I know a lot of people who have said the same thing, because it doesn't do anything for you. When you have a credit card, you can get points, but don't spend dumb stuff on it, right? If you're buying gas anyways, use it for gas. If you're buying groceries, use it for groceries. But don't go and just buy stuff on it just to buy stuff on it. If there's something that you're already going to be purchasing, especially if it's a large amount, and let's say you qualify for one of those programs like we were talking tonight earlier about the business credit cards, and I know that'll be something later on, but the point is some of these credit card companies will actually give you money for spending the money you're already going to spend.
Great answer to that. Because, a lot of times when you buy credit cards, when I was first starting out and I was in college, I would basically work my 9-to-5 job every single weekend. I get like $1,000 every 2 weeks. And man, I made some money. Let's go and spend it all on like really good sushi, or like my new lacrosse team. What is it? It's called lacrosse?
I think so. Yeah.
Anyways, yeah, so whatever that brand with the crocodile is, I was like, oh man, these t-shirts are like $80. They're really beautiful and they make me look cool. So that was actually probably the wrong purchase. And if I was smart enough back then to actually invest that money into something such as real estate like Joe did, I'd be a lot wealthier than I am today. And even though I'm actually at a really good, comfortable position, who doesn't really want more money when you're a little bit older, right? You can do a lot more things. You have the ability to buy your freedom back. You can basically travel when you want to. And if you ever get fired from a job, like say in a really tough recession where people are getting let go, it's nice to have like a buffer and a cushion to basically use that money to support yourself and your family and make sure that you're not basically living under a bridge or basically eating like just peanut butter and jellies all the time, which I do still, unfortunately. But yeah, so thanks for that, Joe. So now that we've kind of talked about like how to improve your credit score and like what you should be spending on, what am I going to do with a really great credit score? What am I going to do with a really good house?
There's a lot of different ways to look at this, and this just kind of brings me back to one of my old customers when I used to work in the car business, because I used to sell cars and then I got into management and I learned finance in the car industry. So that actually helped me a lot in my knowledge today, but I've also helped some of these people who didn't have very good credit build their credit for their own homes. And there was this one customer who bought tons of cars from me and they made a lot of money, but they didn't really care about what their credit score was. And I'll tell you what, they paid a lot of money for that, because when it came down to the banks qualifying them for the car, they had to put more money down, have a higher interest rate than somebody that would have had better credit. So you can essentially get the same item and spend a lot less on it just by having a good credit score and paying attention to it. And then you'll get those offers that we now get because our credit is good. I'm getting offers all the time, not saying that I'm using them, but I'm going to be building them up now for each of my businesses, because I've become such a good credit score that now I can be the guarantor on my new company. So even if I have a brand new company, I have someone that's willing to loan me $30,000, $40,000, $50,000, and I use that to start my next Airbnb, and then I get paid for it, and then I don't have to pay for interest for 15 months or 18 months, and I let that asset actually pay for my credit card back. And we can talk about that forever, but you kind of get the idea, right?
Yeah, so if you're on like the Dave Ramsey mindset, which I really love Dave Ramsey and what he does for people, mainly because his audience doesn't really like finance like me and Joe do. So if you're not honestly following your finances like religiously and you don't have like a clear goal, Dave Ramsey's plan of being debt free is actually really good, and you really shouldn't be taking out credit if you don't know how to manage your money. But for those of you who are really interested in real estate and you're interested in reaching financial freedom earlier than the age of 65, credit is really important, because again, just like Joe said, it's going to allow you to basically borrow at a better rate. So you could be the greatest investor ever, but if you're paying like an exorbitant amount of money for your loans that you're taking on, it's basically increasing your risk, because now your return on investment is lower because your initial investment is technically higher. So when you're basically paying more for these products, or you're paying more to basically control an asset, now your cash on cash return is lower and you're not going to make as much money. So for that reason, credit is technically important, even though we always say like, yeah, it really doesn't matter too much because it's someone else doing it. But if you're trying to really build wealth, it is a good idea, and it is one tool that I think people should actually really take into account. And if you want to learn how to use or fix your credit score, check out this link right here.
Hey, Jeff. What we need to tell people is that their rent is going down the toilet.
I know. So if you really want to take your life seriously and not watch your rent go down the toilet, make sure you take this video seriously, hit the like, comment, sub, and you'll be a lot happier that you did.